Ever feel like the world's gone a little haywire lately? Like those once-in-a-lifetime events, the ones that are supposed to be rare? Yeah, those ones seem to be happening every other week these days.
It does feel that way sometimes, doesn't it?
It really does. And frankly, it can make you feel a bit powerless, like you're just along for this wild, unpredictable ride.
Well, you're not alone in feeling that way. It's something that Nassim Taleb talks about extensively in his work, especially in his book, Statistical Consequences of Fat Tails.
Which is exactly what we're diving into today.
Yeah.
So for those who haven't had the pleasure of grappling with Taleb's work, could you give us a quick rundown? What's the big idea here?
In a nutshell, Taleb argues that traditional statistics, the kind most of us are familiar with, often fail us when dealing with those rare, high-impact events, the Black Swans, as he calls them.
Right? Like market crashes, pandemics, even viral trends, the things that nobody sees coming but can completely upend our lives.
Exactly. Taleb shows how our reliance on things like normal distribution, averages, and standard deviation can actually be dangerous in a world where these extreme events, those with fat tails, are more common than we think.
Okay, I'm already starting to feel a little smarter and maybe a little more terrified all at the same time. So how does this all connect to the idea of Mediocristan versus Extremistan? I've got to admit, those names alone are intriguing.
Taleb loves his metaphors. Imagine for a moment that you're measuring the height of everyone in a school. You'll likely find most people fall within a predictable range. A few outliers, maybe. But overall, the average height gives you a fairly accurate picture of the group. That's Mediocristan, the land of averages, where things tend to even out, and the unexpected rarely throws things out of whack.
Makes sense, but I have a feeling Extremistan is where things get really interesting and maybe a little scary. Am I right?
You got it. Now, instead of height, imagine you're measuring wealth. Suddenly, a handful of billionaires can completely skew that average, making it seem like everyone is rolling in dough when in reality, they aren't.
Ah, I see. The outliers, those extremes, hold much more weight in Extremistan. They can't be easily dismissed or averaged out.
Exactly. And that's Extremistan, the land of wild extremes, where a single event, a single black swan, can have a disproportionate impact. Financial markets are a classic example. 1 minute, everything's humming along. The next, bam, a crash wipes out trillions of dollars.
And all those neat statistical models that relied on normal distribution, on predicting the future based on the past, well, they go out the window.
Precisely. And that's one of Taleb's most important points, but what we've seen in the past doesn't always predict the future, especially in areas prone to those black swan events.
Okay, so we can't rely on the past to predict the future, which, let's be honest, is a bit unsettling. But how do we wrap our heads around these fat tails, these rare but potentially catastrophic events, when our usual tools don't seem to work?
It requires a real shift in thinking. Let's take the example of designing a flood barrier. You might assume that building it to withstand the worst flood in recorded history would be enough, right?
Sounds logical, right?
It might seem that way, but what if there's no data from further back, or if climate change throws even wilder weather our way? What if the worst flood in the past is nothing compared to what the future holds? Relying solely on past data, especially in areas prone to those black swan events, can create a dangerous illusion of safety.
So we could be sitting ducks for something even bigger, even more destructive than we've ever seen.
It's a real possibility, and it's one that traditional risk models often miss. They focus on what's likely, based on what's happened before, without adequately accounting for the possibility of those fat tail events, those outliers that can completely rewrite the rules.
This reminds me of another crucial point. The whole idea of the average can be misleading in Extremistan. Can you elaborate on that?
Absolutely. Imagine trying to calculate the average wealth of people in a room that includes Jeff Bezos. That single outlier, that extreme data point, will dramatically skew the average, making it seem like everyone's a multi-billionaire, when in reality, most people are nowhere near that level.
Okay, that's a pretty clear illustration. So what you're saying is that in Extremistan, in areas where those fat tails loom large, the average can be a terrible measure of what's typical or even what's possible.
You got it. It's like trying to navigate a minefield using a map that only shows the flowers. You need entirely different tools and a completely different mindset to make sense of a world where the extremes hold so much sway.
So if averages and standard deviation can't be trusted, what are we supposed to do? Just throw our hands up in the air and hope for the best?
Not quite. This is where Taleb's work gets really interesting. He doesn't just point out the flaws in our thinking. He offers a new set of tools, a new way of understanding and navigating uncertainty in a world where those black swan events can't be ignored. But to understand those tools, we need to dig a little deeper into the nature of these fat-tailed distributions themselves.
Lead the way. I'm ready to dive deeper.
One common misconception is that the unpredictable nature of fat tails, technically referred to as infinite variance, implies that the average deviation from the mean is also infinite.
Whoa, hold on a second. You're going to have to break that down for those of us who haven't spent our days immersed in statistical theory.
Of course. While it's true that certain statistical calculations become, well, let's say, a bit wonky with fat tails, it's crucial to remember that those are mathematical abstractions. The average deviation from the mean, a measure that's a bit more intuitive, can still be calculated and used effectively.
Okay, so even in Extremistan, not all is lost. There's still a way to get a handle on risk, but we need to make sure we're using the right tools.
Exactly. It's about recognizing the limitations of our old tools and embracing new ways of thinking. That's where Taleb's concept of presymptotics comes in.
Presymptotics. All right, you're going to have to explain that one because it sounds a bit intimidating, to be honest.
It's actually quite intuitive. Asymptotics refers to the theoretical behavior of a system as it approaches infinity. But here in the real world, we're rarely dealing with infinity, are we? We live in a finite world, what we call the presymptotic world.
So presymptotics is all about understanding how things behave in the real world before reaching those theoretical limits.
You got it. And that's where many traditional statistical models fall short. They work beautifully in theory, but often fail to grasp the nuances and complexities of real-world phenomena, especially when those pesky fat tails are involved.
Okay, I think I'm starting to see the light. But how do we actually apply this idea of presymptotics to those troublesome fat tails? How does it help us make better decisions in a world where those extreme events can happen at any time?
It's about understanding that in the real world, in this presymptotic world, we might never have enough data to fully grasp the true nature of these unpredictable distributions. A single data point, one black swan event, can completely change our understanding of the system.
So humility is key. We can't pretend to know everything, especially in areas prone to those fat tail events.
Exactly. It's about recognizing the limits of our models and approaching uncertainty with a healthy dose of skepticism.
Which reminds me of another key point from Taleb's work, the masquerade problem. What is the masquerade and what dangers does it pose?
Imagine you're looking at a stock chart, and it seems remarkably stable, practically a flat line. You might be tempted to think, this stock is a safe bet, nice and predictable. But what if that apparent stability is just an illusion, a masquerade, hiding the potential for a sudden, massive swing up or down that could make your head spin?
So, like mistaking a sleeping tiger for a harmless house cat. You think it's calm and predictable, but you're one wrong move away from danger.
That's a great way to put it. The masquerade problem highlights the danger of jumping to conclusions based on limited data, especially in areas where those fat tails lurk unseen. We can't always tell if something is genuinely stable or if it's just a matter of time before a black swan event comes along and shakes things up.
Okay, so how do we avoid falling for this masquerade? How can we tell the difference between genuine stability and a disaster waiting to happen? Because, I don't know about you, but I'd rather not find myself face to face with that metaphorical tiger.
That's where things get really interesting. Taleb doesn't offer any easy answers, but he gives us valuable tools for navigating this kind of uncertainty. One of the most powerful is the concept of convexity. He argues that it's a far more reliable indicator of a system's fragility or robustness than those traditional metrics like standard deviation.
Hold on, convexity. Sounds intriguing, but you're going to have to explain that one. How does it relate to fat tails and this whole masquerade problem?
Think of it this way. A fragile system suffers disproportionately more from a large shock than a small one. Think of a coffee cup. Dropping it from a small height might not do much, but drop it from a tall building and it shatters. This sensitivity to the size of the shock is what we call concavity.
Okay, so a fragile system, one that's concave, is like that coffee cup. It can handle small bumps and jostles, but a big shock will shatter it. So a convex system would be the opposite then, something that can handle maybe even benefit from those big unexpected hits.
You got it. And in a world of fat tails where those extreme events are more common than we'd like to admit, it makes sense to focus on building systems, whether in finance, business, or even our own personal lives, that are convex, capable of weathering those unexpected storms without falling apart.
This completely changes how we think about risk and design. It's not just about minimizing the likelihood of something bad happening, but about building resilience to those inevitable outliers, those black swan events that can catch us off guard.
Precisely. It's about acknowledging that we can't predict everything, that unexpected events will happen, and designing our systems, our strategies, even our lives, with that understanding in mind.
Which brings us back to another crucial point that we touched on earlier, the idea that our traditional ways of measuring risk, which often focus on averages and probabilities, can be downright dangerous in a world dominated by fat tails. It seems like we need to shift our focus from probabilities to payoffs.
Exactly. And that's a perfect segue into the next part of our conversation.
So last time, we dove headfirst into Nassim Taleb's thought-provoking work on fat tails and discovered why traditional statistics can sometimes lead us astray.
It's about challenging those deeply ingrained assumptions about risk and uncertainty, recognizing that the unexpected isn't always as unlikely as we might think.
Right. Like, we can't just rely on those neat bell curves and averages anymore, especially in a world where black swan events seem to be popping up everywhere. But the big question is, how do we actually use these mind-bending insights from Taleb to make smarter decisions in a world full of unpredictable twists and turns?
That's the million-dollar question, isn't it? And Taleb offers some really practical, albeit sometimes counterintuitive, strategies for doing just that. One of the most important takeaways is the need to shift our focus from minimizing variance to minimizing the impact of those extreme events.
So it's not just about trying to avoid risk altogether, because let's face it, that's impossible, but about making sure those black swans, those outliers, those events that we can't predict or control, don't completely wipe us out if and when they do occur.
Exactly. It's about building resilience, even what Taleb calls antifragility, into our systems, our strategies, and even our own lives.
Okay, I like where this is going. Antifragility. It's like having a built-in shock absorber for those unexpected bumps in the road. But how do we actually cultivate this antifragility in a practical sense? Can you give us an example?
Absolutely. Let's go back to that coffee cup analogy. Remember how we talked about a fragile system, like that cup, being easily shattered by a large shock?
Yeah, one good drop, and it's game over for that coffee cup.
Exactly. Now, contrast that with a flexible, bouncy ball. You can drop it from a height, and it'll just bounce right back, maybe even higher than before. That's kind of how anti-fragile systems work. They don't just withstand shocks, they actually get stronger from them.
Okay, I'm really liking this bouncy ball analogy. So how do we apply this anti-fragility to something like, say, investing? Because let's be honest, that's an area where a lot of people are looking for ways to manage risk, especially with all the market volatility these days.
Right. Well, think of it like this. Instead of putting all your eggs in one basket, so to speak, you create what Taleb calls a barbell strategy.
A barbell strategy. I've never heard of that.
It's actually a pretty simple but powerful concept. Imagine a barbell with weights on either end. On one end, you have your safe and stable investments, things like bonds or low-yield but reliable stocks. These are your foundational assets, the ones that provide a buffer against those market swings.
Right, so that's the certainty side of the equation, the part of our portfolio that helps us sleep at night. But I'm guessing we don't just want to play it safe all the time, do we?
Of course not. That's where the other end of the barbell comes in. You also want to allocate a portion of your portfolio, maybe a smaller portion, to assets with the potential for those outsized returns, even if they come with a higher risk.
Got it. So like those high growth, potentially high reward, but also potentially high risk investments.
Exactly. These could be stocks in emerging markets, startups with disruptive technologies, or even alternative investments like cryptocurrencies.
Okay, I see where you're going with this. So it's still a diversified portfolio, but instead of spreading our bets evenly across the board, we're creating this strategic barbell to weather those market ups and downs, those inevitable fat tail events that can catch us off guard. I like it. Now, is there anything else we can do to manage those fat tail risks in our investments?
One word.
Hedging.
Hedging. Isn't that what those Wall Street hotshots are always talking about? What is it exactly?
It's actually a fairly straightforward concept. Think of it like insurance for your investments.
Okay, so like how car insurance protects us financially if we get into an accident.
Precisely. One common way to hedge against those big, unexpected market moves is through something called options. Options, like having the option to back out of an investment if things start to go south, that sounds like a pretty good deal.
It can be, but like anything else, it has its pros and cons. An option basically gives you the right, but not the obligation, to buy or sell an asset at a predetermined price. So let's say you buy an option that gives you the right to sell a particular stock at $100 per share. If the market tanks and that stock plummets to, say, $50, you can still exercise your option and sell it for $100, limiting your losses.
That makes sense. But what if the market goes up instead? Do I miss out on those gains?
That's the trade-off. If the market goes up and that stock soars to, say, $150 per share, you're not obligated to sell it at $100. You can simply let your option expire, and you'll only be out the cost of buying that option in the first place.
Ah, I see. So options sound like a potentially powerful tool for managing those fat tail risks, especially in volatile markets.
They can be incredibly useful, but like any financial tool, they require careful consideration and a good understanding of how they work. It's always best to do your research and consult with a financial advisor before making any major investment decisions.
Absolutely sound advice. Now let's shift gears a bit and talk about another important concept that we touched on earlier, the idea of focusing on payoffs, not just probabilities.
Ah, yes. That's a crucial distinction that often gets overlooked, and it ties in directly to this whole idea of fat tails and unexpected events.
So can you remind us again what the key difference is between focusing on probabilities and focusing on payoffs, especially when those fat tail risks are lurking about?
Many people tend to fixate on the probability of an event, on how likely it is to occur. But they often fail to consider the potential consequences of that event, both positive and negative, which is where the concept of payoff comes in.
So it's not enough to know how likely something is going to happen. We also need to consider how badly we'll be affected or how much we stand to gain if it does happen, right?
Exactly. And this is especially important when dealing with those fat tail events because their impact can be so much greater, both for better or for worse, than traditional risk models might suggest. Let me give you an example. Let's say you're offered a chance to invest in a company that's developing a new drug. The probability of the drug succeeding might be quite low, perhaps only 10%. However, if it does succeed, the potential payoff, the return on your investment, could be astronomical, maybe 100 times your initial investment.
So even a low probability event, like this hypothetical drug trial, can be a smart bet if the potential payoff is high enough to offset the risk.
Precisely. But here's the other side of that coin. A high probability event can be a terrible gamble if the potential negative consequences are catastrophic. Imagine a scenario where there's a 90% chance of winning $10, but a 10% chance of losing
Oh,
$10,000.
that's a no-brainer. I wouldn't take that bet even if you paid me to. That 10% chance of a massive loss completely changes the equation, even if it's statistically unlikely.
Exactly. And that's why understanding the magnitude of potential consequences, both positive and negative, is so critical when making decisions in a world where fat tails can turn everything upside down. It's not just about avoiding risk altogether, it's about understanding the nature of the risks we're taking and being comfortable with the potential consequences. Which, conveniently, brings us to another fascinating concept from Taleb antifragility. But we'll save that for the next part of our discussion.
Okay, so last time we left off with this intriguing but slightly mysterious concept of antifragility. It sounds like something out of a superhero comic. Fill us in, what exactly is antifragility and how is it different from just being resilient?
You're right, it's a powerful idea. We often talk about resilience, the ability to bounce back from setbacks, but anti-fragility is a step further. It's not just about weathering the storm, it's about actually getting stronger from those turbulent, chaotic events.
So not just bouncing back, but bouncing back higher.
Exactly. Imagine a muscle, right? If you only ever lift those tiny weights, you're never really challenging it, so it never gets any stronger.
You might even get weaker, right? If you never push yourself, those muscles will atrophy over time.
Precisely. But if you progressively increase the weight, challenge those muscles with heavier loads, they experience a bit of controlled stress. They might tear a little, but then they rebuild, they adapt, and they come back stronger than before.
So a little bit of stress, a little bit of chaos, even a little bit of failure can be a good thing. I like it. So how do we apply this anti-fragility thing to our own lives? especially in a world that often feels determined to throw us curveballs at every turn.
It's about embracing those curveballs in a sense, not recklessly, of course, but with a certain calculated boldness. Don't shy away from challenges or try to avoid failure at all costs. Instead, view those challenges as opportunities for growth, those failures as valuable learning experiences.
So instead of building walls to protect ourselves from uncertainty, we should be building those anti-fragile systems, those anti-fragile mindsets that can adapt, evolve, and even benefit from those unexpected events.
Exactly. And we can apply this principle to so many areas of our life, our careers, our relationships, our health, even our hobbies. Don't be afraid to experiment, to try new things, to step outside your comfort zone, even if you're not sure where it might lead.
This reminds me of another concept Taleb talks about, the idea of optionality.
Exactly. Creating more options for ourselves, more potential paths we can take, is a key part of building that anti-fragility. It's about maximizing our freedom to adapt and respond to whatever life throws our way.
So it's not just about having a plan A and a plan B, but about having a whole alphabet soup of possibilities, knowing that things might not go according to plan, and that's okay.
It's more than okay. It's essential for thriving in a world of fat tails, a world where those unexpected events, those black swans, can either make us or break us.
This has been an incredible deep dive. We've covered so much ground, from the theoretical underpinnings of fat tails to those practical strategies for building anti-fragility into our own lives. If you have to leave our listeners with just one key takeaway from Taleb's work, what would it be?
That's a tough one. But if I had to choose, I think the most important message is this. The world is inherently uncertain. We can't predict the future, and we can't control everything that happens to us. But we can control how we respond to that uncertainty. We can choose to be ruled by fear, or we can choose to embrace uncertainty as an inherent part of life, even a source of opportunity.
It's about shifting our mindset from a desire for absolute control, which is an illusion anyway, to an acceptance of uncertainty as a fundamental reality. And in that acceptance, in that embrace of the unknown, we open ourselves up to a whole new world of possibilities, of resilience, of growth, and yes, even of anti-fragility. It's been a pleasure exploring these ideas with you today.
The pleasure was all mine.
And to our listeners, we hope this deep dive into Nassim Taleb's statistical consequences of fat tails has given you a lot to ponder. Remember, the world may be full of black swans, but with the right mindset and strategies, those unexpected events can become not something to fear, but opportunities for growth and transformation. Until next time, keep exploring, keep questioning, and keep embracing the wild ride of life in Extremistan.